Pension Fund Investment Subcommittee meeting, including members of the public watching via the Council's YouTube channel and local pension board members attending via Zoom. A couple of housekeeping points, as some of you may be new to this building. Toilets are available in the corridor adjacent to this room. There's no fire alarm test scheduled for today, so if the alarm sounds, I will adjourn the meeting and we will all make our way downstairs and out of the main entrance. Muster point is on the green opposite the main entrance. The meeting room has been arranged to comply with public health guidance on COVID safety. Could everyone please wear their face coverings when moving around the room and building? Can I ask that everyone present turns their mobile phones to silent or vibrate whilst the meeting is taking place? Dawn, do we have any apologies?
No apologies, Chair, though we are expecting Councillor Bowden.
Okay, thank you very much. Does any member wish to declare any disclosable pecuniary interest or non-statutory disclosable interest?
Yes, Chairman, thank you. John Walker. I am a retired member of the scheme. My son and daughter-in-law are both deferred members of the scheme.
Okay, thank you. Okay, so turning to the action log, Richard and Mark, do we have any comments or updates?
There are no updates on the version in the pack. Do you want me to run through each item, or are there questions on them?
Members, any questions on the action log? Okay, we are asked to note the action log, and I assume we're happy to do so. Thank you. Okay, item 3, the Cambridgeshire Pension Fund Investment Monitoring Report for the quarter ended 31st of December 2021. Can I ask Peter Gent to present this report, please?
Well, Chris, start. I will.
Perfect, thanks, Pete. Okay, great. So if we start with the executive dashboard, which is in page 7 of the meeting packs, and I'll talk through each of the key headlines shown on this dashboard, and then we can drill down in a little bit more detail in each of the individual areas. So at headline level, in terms of funding, Q4 saw growth in the fund's estimated liabilities to 3.96 billion, as largely driven by the falling gilt yields that we saw over the quarter. Asset growth in Q4 of 132 million to 4.31 billion didn't quite keep pace with the growth in liabilities over the quarter, which caused a small fall in the funding level from 111% at the end of Q3 2021 to a still healthy 109% by the end of the year. The pension fund, in terms of asset allocation, was 4.4% overweight to its strategic allocation to equities. This reflects the strong equity market returns over the year, and in turn has led to a 3.7% underweight position within alternatives. Now, this largely reflects the slower pace of drawdowns into private equity in particular, and also in property and the M&G shared ownership fund. So it takes time to draw down the monies to invest in these asset classes. So we would expect over time that underweight will be addressed. Performance, so relative returns in the bottom left. The fund's return was 1.9% behind the overall benchmark return in Q4. Strong equity returns over the quarter and the activity taken to restrike the equity protection position in Q4, and that's on later on the agenda. Pete will talk through that in a bit more detail. That crystallized a 0.8% loss of upside given the strong equity market returns that have been experienced. Also, Dodge & Cox, which are one of the global equity managers that follow a value style approach, underperformed their benchmark, which contributed minus 0.4%, and that was more than offset by strong outperformance from J.O. Hambro over the quarter, which added 0.5%. 1-year returns are broadly in line with benchmarks, so 16% return, strong double-digit returns over the year, so very strong 2021 for fund returns, largely driven by a strong period for growth assets and equities. 3-year returns are 1.7% behind the benchmark return of 14.2, so delivering a return of 12.5% per annum over the 3-year period. So still very strong performance in absolute terms, but slightly behind benchmark. And we can talk through the key drivers there as we move through the report. In terms of manager research, there are no material developments over the quarter to note. However, we do have an update on Longview given the enhanced monitoring that's in place on that particular mandate. If we move forward to the next page, which shows that the market index performance, and this helps to tell a story of what happened over Q4, which is the chart on the top, and also what happened over 2021 over the calendar year, which is the chart on the bottom. So starting with Q4, it was a supportive quarter for growth assets, and you'll see that on the left-hand side. So again, strong positive returns across different regional equity markets, although Asian equities and emerging markets did lag. So slight negative returns for Japan and for emerging markets. There was a strong bounce back in developed economies post-COVID, and corporate profitability has been strong going into Q4. And that's also coupled with an expectation that central banks will be measured in their approach to paring back some of the support that they introduced in 2020 to prop up economies when the COVID pandemic first struck. The quarter also saw the emergence of Omicron. There was a mild initial negative reaction around fears that could cause further lockdowns, although as we moved through the quarter, much of that position was undone as it became clear that the lethality of the virus, of the variant, and also the vaccine resistance data were also supportive. So that again helped to prop up markets over the quarter. You'll see that positive returns for gilts and for index-linked gilts reflects the falling yield environment. So again, a fairly benign market environment, and they could be used as a proxy for effectively growth in liability values. To bring us slightly more up to speed, it's been the opposite story so far in 2022. So we have seen those gilt yields starting to rise. That has led to negative returns for defensive bond assets and for equity markets in particular. And again, I can talk through that in a little bit more detail. What we have seen so far this year in 2022 is potentially sort of higher and stickier inflation coming through. We've also seen stronger than expected central bank action. So Bank of England at the start of February decided to increase interest rates. And also there was an indication that they were considering a larger increase than actually was implemented. So they raised rates by 0.25%, but actually 4 of the 9 members of the MPC voted for a larger 0.5% hike. And that's led to what we've seen so far over the start of 2022. 12-month returns on the bottom look very, very strong, pretty much across the board in terms of growth assets. So strong double-digit returns across equity regions. Gilt returns were slightly negative, which is a reflection of gilt yields rising over the year and also stronger inflation. I suspect we won't see many years like this for DB pension schemes, where we have strong double-digit returns for growth assets and also modest changes to liabilities. We move on to the next page, which shows us the progression of the funding level over time. So the result of what we've seen over 2021 is an increase in funding level, so around 100% at the start of the year, increased to 110% in Q1, and it stayed there or thereabouts over each quarter end since to the end of the year. So again, maintaining a fairly strong funding position over the course of the year. If we move on to the next page, please, Pete. So this shows the strategic allocation in the pie chart on the left-hand side of the page, and it shows the deviations, the pension fund's asset portfolio on the right-hand side. I think the key takeaway here is the strong equity overweight I mentioned earlier. So approaching 5% overweight to equities. And that's offset by underweights to property and private equity in particular, for the reasons I mentioned earlier, that it takes longer to draw down the capital to help build up these mandates towards their strategic allocations. As I touched on previously, we've seen almost a reversal of conditions in 2021 as we've moved into 2022. And those market conditions and those index returns are likely, as of today, things could obviously change by the end of the quarter, but are likely to have addressed that to an extent, given the negative returns for developed market equities. So we're likely to see that global equity overweight having reduced, but at the end of the year, a material overweight off the back of strong equity market returns. The following page, we start to run through the manager allocation at individual manager and at sub-asset class level. What we'll see is that actually at manager level, Joe Hambro have driven that active equity overweight, given the strong returns that they've experienced. And passive equity with 3% overweight, again, just driven by strong market index returns. And multi-asset credit, which is shown towards the bottom of the page, is underweight and has moved more underweight over Q4. And that's really reflective of the market value being relatively flat over the quarter. And so just offsetting the growth in equities. So the equity overweight has effectively pushed multi-asset credit marginally more underweight. Again, if we bring that more up to speed in terms of where we are today in 2022, I think we're likely to see that position reverse slightly, with multi-asset credit expected to hold out better than equities in an equity down market, so a slightly more defensive asset class. Pages 12 and 13, so we start with page 12, we move through the alternatives portfolio. And again, this is where we can see where the underweight position comes out in terms of underlying managers. So alternatives at overall level, 3.7% underweight. Now the key underweight positions here, M&G shared ownership, which is a relatively new mandate, so a 0.3 allocation versus a 1.5% target allocation. And again, we'd expect over time, as capital is drawn down into that portfolio, it will move towards its strategic target. And then private equity towards the bottom of the page, so 9.7% actual allocation at the end of the year versus a 12% target. And again, that will be addressed by further commitments to private equity funds, to Adams Street Partners and to Harbourvest in particular, to help bridge that gap. Following page on page 13 shows us the infrastructure position. So infrastructure was actually overweight within the alternatives portfolio. So 6.5% allocation at the end of the year versus a 6% target. We're comfortable with that overweight position. It does help to offset the underweight position within private equity and help to manage the overall alternatives allocation towards its target. It will take several quarters, if not a couple of years, to get private equity up to target. So having a modest overweight to alternatives helps to balance that and helps to keep the pension fund exposed to private assets and to alternatives on the whole. Page 14, we start to move into manager performance. Now, on this particular slide, you will see the impact of the equity protection mandate that I touched on earlier, which was one of the, I guess, the detractors from overall performance. So if we look at the below the total, we have total equity returns. So over Q4, 5.7% against the benchmark of 6.1, and over the 1 year, 22.1 against 20.4. So strong equity market returns and strong, reasonably strong relative performance over the 1 year period. The row beneath that shows the impact when we include equity options. So this is, again, effectively the insurance policy that's in place that will cost the pension fund when equity markets do deliver strong positive returns, and will be expected to protect the pension fund if equity market returns are negative on the downside. Given that over the 1 year period, we have seen strong returns, so 20% return over 2021 and 16.4% per annum over the 3-year period, then as expected, the equity protection has effectively had an opportunity cost in terms of loss of upside, which has led to marginal underperformance over the 1 and 3-year periods. I guess to put this into context, 14.9% versus 16.4 over the 3-year period, so 1.5% underperformance. Arguably, you would take that over rolling 3-year periods, given the strong return. So you're willing to take that downside if you are getting double-digit returns on a long-term basis. So it's not necessarily a negative story to tell. I think when Pete usually presents this report, he likes to talk about it being the wrong way round, and that it's better to read from right to left than left to right, given the importance of long-term returns and not focusing too much on quarter by quarter variance, as managers will tend to underperform and outperform over the short term. With that in mind, I think there has been some underperformance within the equity portfolio in Q4, as to be expected. So I'll try and focus on the 1 and 3-year returns in particular. Now, if we run through almost line by line, we've got Joe Hambro as the first global equity manager within the list, and over the 1 and 3-year, they've delivered strong outperformance versus the equity market. It's been favourable market conditions, so positive index returns, and Joe Hambro follow a growth and momentum style approach, so they will be expected to perform strongly in those market environments, and they have done over those longer term periods. That's a positive story to tell. Dodge and Cox are the next line, and you'll be familiar with their investment style. So they follow a value investment style, tend to invest in stocks that will perform stronger and more favorably in conditions that support defensive positioning. So they tend to be in sectors such as utilities and energy and financials more so. And this has been one of the few years where value has outperformed growth, and that's shown by the benchmark returns. If we look at the 1-year benchmark return for Joe Hambro of 19.6%, that's the global equity market on the whole, whereas Dodge and Cox are measured against a value index, which more closely represents their style. And over the year, that delivered 21.5%, and Dodge and Cox delivered in line with that. So they've performed in line with expectations for a manager of their investment style. Again, over the 3-year period, they have outperformed, so 2.4% above the value index, but they have underperformed versus the wider global equity index. So they've done well for a value manager, but value has underperformed, and therefore Dodge and Cox have underperformed over the 3-year period. Longview, the next manager in the list, and despite some underperformance over Q4, the 1-year return is positive in relative terms, so they've outperformed by 1.5% over the year. I mentioned earlier the enhanced monitoring that's taking place for Longview. The latest quarterly update has been completed, and the key takeaway really for Longview is that they have continued to see some client outflows, although strong performance has offset that in terms of assets under management, so it's been stable over Q4. They have underperformed again over the short term over Q4, but 1-year returns are reassuringly above benchmark. So no change there in terms of it to continue to keep a close eye on assets under management and performance as well. Fixed income towards the bottom of this page. Sorry, I've skipped past UBS passive equity. That's a passive mandate. They're performing broadly in line with index, as you would expect. And then fixed income towards the bottom of the page, we've got River and Mercantile's passive bonds, again, performing in line with index. And Blue Bay and M&G, who are the two multi-asset credit managers. Now, one thing that the figures here do mask is actually the performance since inception. So despite some underperformance over Q4 and in aggregate modest underperformance over the 1-year period, both Blue Bay and M&G got off to a strong start after they were appointed in 2020, and those figures in late 2020 don't come through in this report in the 1-year return. So actually, despite the 1-year returns looking okay versus the comparator, they have got off to a reasonably strong start over the sort of 1.5 year period since inception. The next page, so page 15, we move on to the alternatives portfolio. There are some striking large numbers here, and I'll help to explain them and to put them into a bit of context as well. First of all, we'll look at property. So Schroders property portfolio at the top, they manage a core portfolio, so core sector exposures, office, retail, industrials. They've been modestly behind benchmark over the 3 and 5 year period, but not to the extent that would cause us alarm. M&G's residential property portfolios, again, they invest in residential style build to let type properties. They have, first of all, they're measured against an absolute return target of 6% per annum. It's worth noting that over the particular period in question, so 1 and 3 years, it's been a tough period for residential property funds. M&G's portfolio had a number of development opportunities that unfortunately meant that there was a lag in them being fully let. So letting activity did slow down, as you would expect during COVID. And that's caused the relatively uninspiring performance there, but still marginally positive, given that this portfolio is expected to deliver a large proportion of its return from the income yield and from the rental yield. Hopefully what we should see now as we move into the COVID recovery period is those opportunities, those residential properties becoming more let, and we'll see more of the income come through, and hopefully those performance figures should start to move closer to the 6% per annum target. Other alternative asset returns as we move down into private equity and infrastructure for completeness are shown to the end of Q3, just given the lag in data. There are some large numbers in here, and again, to put those into context, I'll just make clear that these returns are shown in local currency basis. So for example, Harbourvest and Adam Street Partners over the 1 year have delivered 62.8 and 74% annual returns, incredibly strong returns. They're shown in US dollar terms, but also those figures really represent how the investment process works for private equity, in that the managers will use a credit facility, they will invest in private equity assets, they will get strong performance for a relatively small initial drawdown from investors. So we're seeing a strong return for a relatively small level of capital that's been invested. Over time, you will expect those to drift down towards the target, still hopefully above targets, as capital is actually paid from the pension fund to the managers. We certainly won't see 74% annual returns over the medium to long term, but still, again, a reassuring start to those relatively new commitments that have been made. Foresight have made a slightly slower start, and actually the difference in benchmark there is reflective of the currency. So Foresight is a UK mandate, and it's shown versus a sterling global equity index, which is why it has a slightly lower benchmark return, but nonetheless a slower start for that mandate with a -2.2% return over 2021, but still very early days for private equity, which has a longer term investment horizon. Infrastructure, again, trying to focus on the 1 and 3 year figures. There's a fairly mixed bag of returns here. I think the key standout negative return is UBS. So over the year of -20.7%. I think reassuringly, this is one of the smaller mandates in terms of asset values, and it's very much in the later stages of being wound down. If we move down the list towards IFM and JP Morgan, which are the two newer mandates within infrastructure equity, we'll see quite a strong 2021 for both funds. So 16.6% return over the year for IFM and 7.9% for JPM. And those pattern of returns is actually as you would broadly expect, given JP Morgan tend to be the the slightly more core or slightly lower risk mandates, and IFM do take a tiny bit more investment risk. They're a little bit more exposed to the economy and to GDP. Their portfolio has more cyclical assets. It tends to hold more transportation-like assets, so airports and toll roads that will have suffered in 2020, and those figures don't necessarily come through as much in the one-year figure, but I've seen a strong recovery in 2021. So again, positive across the IFM and JP Morgan infrastructure equity portfolios. Now, the remainder of the presentation covers off a much more detailed and in-depth drill down on a manager by manager basis. I didn't plan to go through them in more detail, so perhaps this is a good opportunity for me to pause. First of all, for any comments that Pete might like to add, and secondly, for any questions.
Thanks, Chris. I think the only comment I would add was that there was an announcement from the government on the levelling up agenda around local investment and a 5% local investment. What that means for pension funds is very much open to interpretation, open to questions, which we probably won't cover here. Obviously, through that foresight mandate, we have made moves as a fund to invest locally. So we are on that road. I would imagine in the vein that it would like the committee would like it to be in terms of that push on local investments. But just something to kind of highlight, there is that direction of travel to look at those sorts of things, but the interpretation probably needs a little bit of work there.
Hey, members, any questions, comments? That's right.
Just a quick comment on the dropping funding level. Presumably that's due to increased provision for inflation in the liabilities rather than because the assets have actually risen.
Yes, to an extent. I think what we've really seen is growth in both assets and liabilities, but the extent of the liability growth has been higher.
But that liability higher is because of inflation or because of?
Broadly, inflation coming through has led to a rise in liabilities, yes. And what we're seeing as well is essentially a falling yield environment over Q4, but that's likely to have been reversed from what we've seen so far in 2022.
Thank you.
Any other comments, members? In which case, if I could just ask, I guess, for a little bit of reassurance, when I look over these figures in general, what we're seeing is that there's been, quite a number of areas of underperformance, even when we're sort of looking, I'm just looking here at the equities page and, or rather the total on the net manager performance page, and you're looking at 3.3 in a quarter, but that's 0.3 down on a 1 year, it's 0.9 down on 3 years, it's 0.7 down on 5-year benchmark. It seems to be a continuing underperformance. We look at obviously Dodge and Cox. Yes, it may look like they're okay there, but they're significantly under benchmark in the quarter. Is it an indication that there are changes happening that we need to be thinking about? When we then look down in the alternatives, the significant number of negative return figures on there are clearly having an impact overall. And how are we managing that to avoid this becoming a serious matter?
Yes. Yeah, on the equity point, what we're trying to do is build a kind of long-term, robust strategic portfolio that has lots of different return drivers versus a benchmark return that has been driven by very particular sectoral exposure. So we think about particularly post-COVID and post-March 2020, the benchmark return has been driven very heavily by US tech stocks. So to kind of keep up with that rampant benchmark and 16.4% per annum over a 3-year period is extraordinarily high levels of return. We would have to be very heavily exposed to those sectors to really keep up. Do we want to be there from kind of a risk managed, robust equity portfolio point of view, I would suggest probably not. We want to be a little bit more spread around. So on aggregate, we're comfortable with underperforming in that market environment, particularly when it's been so concentrated in terms of a sectoral exposure. Now, that's not to say that we shouldn't question underperformance, and we are doing that through answering this question, I guess, and particularly looking at individual mandates. And there is that challenge of the Dodge and Cox mandate in terms of it has underperformed. We kind of understand why it has underperformed, because it almost has that opposite sectoral exposure versus what's really driven the benchmark. So we're comfortable there, but we should be continuing to challenge that, because we shouldn't just take underperformance. In terms of the alternatives, again, it's right that we challenge that. We talk about this every time in terms of there are issues in terms of measuring performance of the alternatives, particularly when they are small in their ramp up phase, as Chris has pointed out in the private equity, and in their drawdown phase when the life of these assets kind of come to an end and they're being sold off. You know, when you look at the size of that UBS infrastructure mandate, it's 8.5 million, so really rather small. So it only takes one asset to sell at a price that's slightly under where the manager was booking it in terms of what they expect the value to be, to have quite a meaningful impact on performance. Again, not something we should just pass over lightly, but something we should look into and explain, and particularly on infrastructure. Some infrastructure assets have had a rocky time throughout COVID, especially when we think about transport. So there are reasons for underperformance. Again, it depends on the sectoral exposure. We've talked about this a few times. We do sort of a deep dive into private equity on an annual basis that we will do in the coming weeks to kind of look at those exposures. Maybe that's something we start to do on the infrastructure piece as well. It's something you tend to do on an annual basis because the data's quite slow to come through and it's quite difficult to measure, but just to see where we're exposed so we can answer some of those questions as opposed to kind of thinking about it at the high level. But it's absolutely right that we challenge it and we look at it and we think about it and we think, how do we want to move this portfolio forward? Because in terms of if we want to take action over any of those current mandates, then we are somewhat limited because they are sort of close-ended real assets that we own a share of.
Thank you for that. Just in terms of, sorry, did you?
I was just going to add a comment around that bit.
Yeah.
So yeah, I think if you recall, we reflected that benchmarking was imperfect in that alternative space. So I think there's so much going on in there, and so somewhere like Harbour Vest and Adam Street, you've got lots and lots of vintages all wrapped in, and you're seeing the average come through. Whereas some of those are absolutely tiny, like the Foresight. I mean, they made their, I think it was their fourth investment of 4.1 million. Which you may have seen in the news just the other day. So it's completely different from the other funds. So I think that's a fair thing. I think the other thing I would add is I take more meaning from the listed numbers, performance versus benchmark certainly. But we're all trying to do some different things now. So yes, we've got that diversification through Dodge and Cox as well, but the risk management decision around the equity protection also creates a drag, which with some other funds wouldn't have. Of course, if it had gone the other way and markets hadn't done really well, then we might have benefited from that in a financial sense as well. So I think we have to recognise that you're comparing very different things when you compare benchmark numbers now. But as I say, right to answer questions and challenge.
Thank you all for that. Just one further question around Longview. Obviously, that's been heavily under review along the way. The performance obviously is certainly in line with what other people are achieving at the moment. Are we happy that the Longview position stays as it is at the moment?
A news update in the sense that to the next joint committee, there is likely to be a request for a new quality manager search. And obviously that would be a future solution. But I won't, I can't overemphasize, these are quite long timelines when we're dealing with access. But that request has now been put in and will be formally considered. But I'll let Peter answer directly to Longview. So.
Yeah, and it's why we're doing this enhanced monitoring. There have been changes at Longview. There have been outflows, and as a reminder, Longview is kind of a single fund business, so they run this fund and nothing else. So if you see large outflows, then the validity of the business starts to come into question. We've seen some outflows, but they haven't been material enough for us to be concerned, which effectively buys us time for that process to work through, and some of the other strategic decisions we might make later today to work through, and how we look to remold our equity portfolio in the future. Now, if that escalates in terms of being more concerned, then we would want to make a quick decision to park the money in slightly lower risk, or so it's slightly lower active risk position. There were some decisions made by the previous committee over that. I think we'd need to check the delegations in terms of what they look like over that trigger point, but that is why we're doing the enhanced monitoring. But net short term, we're still reasonably comfortable as a going concern.
Thank you very much.
Apologies, Chair. Can I ask a question? Just because that. Just look at the residential property one, and the considerably below the benchmark for the last year and the last 3 years. Just stories a little odd. There's been strong growth both in rental returns and capital values. I know there's been a couple of unusual years in terms of construction and cost of construction, but I was just wondering why that one seems so much lower than the benchmark.
Yeah, it's a really good question. I think there's two factors at play here. The first is it's an absolute return benchmark. So the benchmark of 6% per annum doesn't reflect what's actually happening within the market. So it's useful over a long term, but actually over sort of maybe the 1 year period, and arguably sort of the large majority of the last 3 years has been COVID impacted, it becomes slightly less useful as a barometer of how the investment manager has done. I think the second one is in terms of residential property, much of the return comes from the rental yield it gets on its property. So it does rely on its investment portfolio, the properties within it being largely or close to fully let in order to get that rental income, rather than capital appreciation of the underlying properties. And given the portfolio has gone through a stage maybe 2-3 years ago of actually building out some of its development opportunities and essentially building these properties from scratch, it's been difficult to get that letting rate up close to where it needs to be. Just given what's happened with COVID, it's hard to let out properties, and I guess in the middle of a pandemic, and that's what's really hurt them. You would hope and expect that those figures will come much closer to the 6% target over time. I think you can start to see that come through in Q4, where it was still behind the 1.5% quarterly absolute return target. But actually, if you sort of if you consider that over a 1 year period, it's starting to approach its expected income yield of sort of 4 or 5%, with a little bit on top for capital appreciation. So I think you will see it come through over time. You would certainly hope it would. And it's understandable as to why it's not reached that 6% target.
Thank you very much for that. Any other comments, questions? No. In which case, the subcommittee is asked to note this report. Are we happy to do so? I would take that we are. Thank you. Okay, we move on to item 4. The following items on the agenda are exempt from publication, so the subcommittee will need to decide whether to exclude the public and press from consideration of the following items on the grounds that the reports contain exempt information under paragraph 3 of part 1 of Schedule 12A of the Local Government Act 1972 as amended, and that it would not be in the public interest for this information to be disclosed information relating to financial or business affairs of any particular person, including the authority holding that information. May I ask if there is general consensus in support of the recommendation so that the subcommittee can take it now? Okay, thank you. If we can. Okay. Right, item